Good afternoon, everybody. Hope everybody's having a great day. Up next, we have Jeffrey Beamer starting in 5, 4, 3, 2.
Hey, good afternoon, everybody. Jeffrey Beamer here, and I am flying solo today. Hope everyone's having a good day today. Got a little market volatility going on. Tom is taking, got some other things he's juggling, so I am going to be with you for the next little while. And we are going to be talking about selling premium in a volatile market. All right. This is both can be ideal and be a little terrifying. So I'm here to help kind of calm those waters a little bit. And for those of you that don't really know me, don't know much about me, hey guys, you're in, at least I think you're in good hands. I've been in this business for over 30 years. I'm a former hedge fund manager. Okay, I've managed and started multiple firms over the years. I was not only a hedge fund manager, I ran an onshore offshore hedge fund for many years. But I'm a former mutual fund manager also. And remember, mutual funds are things that really anybody can invest in. And so one of my products was a mutual fund that was available, and it was a specialty fund, and it was actually just before we moved on to other things. We had a 5-star rating from Morningstar, so which was I was pretty proud of. So I've been in this business for a long time, and I've got I got tons of stories, but we're not going to share those. But lots of I've seen lots of things, and there are certain things that repeat and certain things that don't. And one of the things that don't is the market environment to which we are in. So yes, we've seen high implied volatility before, but not necessarily with the current situations that are driving that for, inflation, movement from Russia, or, political things. So everything's a little different, even though when it comes to option premium, we've seen it before. Okay. And so what I'm going to do is address some of those things. We're going to go over it. And let's start off with kind of taking a look at the broader market and see where we're trading. And this is pretty amazing looking at the Spider Index Trust here, SPY. All right. You'll notice here that we have come down and tested a major support area. And lucky enough, we did hold that area, okay. And I'm talking about this Fibonacci line right here, or this area here. We held that area pretty well, and that was, of course, around that 420, 425 area. All right, and we have popped up above that, and we're having a good day today. Okay, now that's the good news. The things that we need to kind of keep an eye on, so it's not necessarily bad news, but some of the things that we need to keep an eye on are some of the technicals. All right. The short-term moving average is pointed downward. All right. This is my 21-day moving average. Okay. That's the short-term moving average that I use, that 21-day. All right. And then a 161 moving average. Which is this light blue line here. And as you can see here towards the most recent days, this thing is starting to curl over itself. Okay. So technically, hey, where are we? What's going to happen? All right. There's some earnings coming out. I think First Solar had earnings yesterday, FSLR. So we're right, we got some stocks that are having earnings events, but really it's geopolitical and inflationary news that is driving this market. And we could be making a lower high here is what technically we're looking at. We could move up to this short-term moving average or somewhere around here and then have another move down. That is yet to be seen. Okay. But so what that does for your portfolio is it should make you aware of how you're positioned. Are you long stock? Are you delta positive or net long in your options position. Okay, these are things that we want to be aware of, and if we are, well, it's not too late to take your foot off the pedal a little bit, to ease up. All right, because there's one. Oh, actually, there's one in here, ETF or that I don't have listed that I want to look at here. But let's go through some of these. So Spider, net, hey, we're off our lows. We are having a little bit of a rally here, but take your foot off the gas pedal for you bulls. Okay, we shall see. There's that old rule out there: don't fight the Fed. Okay, so not only do we have higher inflation, not only do we have geopolitical events, but we have we have the Federal Reserve still talking about a 100 basis point, which is 1% move to the upside for interest rates. Okay, we'll see that in a minute. All right, now looking at the tech sector. Okay, this is the Qs. The Nasdaq, which is representative of the Nasdaq, of course, very similar. All right, we're trading off our lows, looking at testing our short-term moving average. That will be critical. We could see a pause there and possibly a rollover. So just remember that if you have some positions in something that's tech heavy or that is highly correlated to the Nasdaq stock market. Okay, same story there. Now, small caps is a little bit interesting. Okay, this is the IWM, which is representative of the Russell 2000 index. And you can see that we've been selling off for a while. And then the stock or ETF came down, found a pivot low here at just above 190. All right, rallied higher, and then retested this low. All right. Now, what's interesting about this, and I didn't see it at the time, but it reminds me of an old general trading rule that when markets experience a high level, a big move under stress, okay, and usually it's a move similar to this, okay, market drops, all right, and it's implied volatility blows through the roof, bid-ask spreads widen, things get, everyone's a little nervous how fast, how hard we are going to drop. But the rule states that once we establish that base, once we establish that low, okay, and begin to rally, you can expect us to revisit that low, okay, meaning this low, once again. Man, my arrows are awful. All right, once again under more normalized environment, market environment, okay, when things have calmed down a little bit. This is, if you recall the flash crash from 2000, what was that, 12, 13, somewhere in there. The flash crash for the spiders dropped like a rock, implied volatility exploded, bid-ask spreads exploded, and you're seeing, and what I mean by exploded is normally on the SPY, which is spider, all right, SPY, you have bid-ask spreads that are a few pennies wide, okay? The bid's a few pennies lower than the ask or the offer, and it's just a few cents. Back in the flash crash, when that happened, those spreads went over $1 wide, okay? $1 wide as market makers were protecting themselves. Nobody really knew what was going on. Now, what you may not recall is that, that day we crashed down, but then by the end of the day, we were rallying up, okay? Well, 2 weeks later, we revisited those lows once again, okay? But things were normalized. When we came back down in SPY, we came back down. Those spreads were still were normal. They were just a few cents wide. Why? Because now we know what to expect. The sell-off was more organized, not high volatility. Well, the same thing. That's what this pattern reminds me of where we came crashing down, we fell off, and then we revisited things when things are calming down a little bit, and now we're bouncing off. And as you can see, we've regained that short-term moving average. So if we can make a new high above 205 and climb higher to 210 on IWM, that's a bullish sign. And small caps can move in a little different direction than the broader market. So that's one thing to kind of keep in mind there on small caps. All right, so let's talk about energy for a little bit. Now, this one is really interesting because we have been talking about $100 oil, okay? But the question is, and this is what cracks me up about most analysts, they never tell you when, okay? They kind of guesstimate. I've heard this summer, maybe the fall, we'll get to $100 oil. That's not what the technical showed. The technical showed mid-March to early April that we would hit $100 barrel on oil, okay? But we here March 2nd, we're there. In fact, it hit $100 yesterday and actually blew through it, okay? Today, we're up again, but the candle today is very interesting. You're looking at USO here, but let me jump over to the front month crude oil futures. Let me see if this will pull up here. All right, so this is the front month crude oil futures, and we have a very interesting candle developing. Now, I don't have, in a minute here, or a second, there'll be some more technicals pop up here. Okay, there they are. All right, we're getting to be overbought on crude oil. Okay, we've been there, we've been here before. Okay, but this candle is very interesting. Okay, this current candle, today's candle, this candle right here. All right. And what that candle represents is this could be a blow-off top for crude oil, okay? Meaning we could possibly expect, now that we've blown through $100 and we're trading at 108.43, okay? We had a high up here around 112, okay? It would not surprise me if actually we came back down below 100. Okay, wouldn't surprise me if we stop there, but I think we'll go into the $90 range before regaining 100 again. I think triple-digit crude oil is here for a little while, and that is a challenge for a lot of people. Okay, you know, it does translate eventually to the pump. It's not a direct correlation, but my goodness. It can really play havoc with the economy when you have crude oil in the triple digits. Okay, now I'm here in Texas. All right, so there's certain people that I know that are actually they're in the business and they're not really happy about it. Okay, they're making a lot of money, but they don't like to see when crude oil is at these prices necessarily because of the effect that it has. Okay, but let's not digress too far. Okay, so just wanted to show you that crude oil has gotten there. It's busted through $100, and that's kind of my outlook there. This could be a blow off top. We could come back down, retrace, retarget 100, maybe even the lower 90s, but we'll come back up to 100 if we do that. Okay. Let's take a look here at also natural gas. It is off its lows and elevated. Okay, $12 base back in December and early January is long gone, and we're seeing natural gas above both moving averages once again, and which is interesting because we're moving into spring, and usually this is what happened to Amaranth back in the late 90s. Amaranth was a big hedge fund, and they took a seasonal bet on natural gas that it would rise going into the winter months, going into the fall. Okay, and it didn't, and they went out of business. because they were over leveraged and undercapitalized. Okay, is the bottom line. But here, we would expect going into spring, okay, that we would see a drop. All right. But interestingly enough, take a look at this. Back here in previous months, look at this. We were in the winter. We were headed into winter, and it was dropping. Okay, so it has really been forward looking, and I don't know, if we're off cycle or how long this off cycle will last. Maybe this is a new environment. Okay, but it's interesting. Traditionally, we've sold off in natural gas in the spring. It's risen in the fall as we head into winter. Okay, all right. So that's natural gas. Now we'll take a look at some bonds here, real quick. We have. I'm sorry. Let's look at metals real quick. Gold, testing 180 and 1800 for gold itself, and we're struggling here. We've tested it now for several days, but it is elevated and it has had a really good move here recently. So still bullish on gold as far as when it comes to inflation and some of these world events. Gold will still be a good place to be. But interestingly, note about gold and silver that you're looking at now, SLV, is which is also elevated, is that these things are actually somewhat correlated to the S&P 500. I found that out when I was just doing some research. They don't always move in direct correlation, but their correlation to the broader markets was actually higher than I thought. Okay, but nonetheless, while we've been struggling in the broader markets, here in the gold and silver market, we've been doing just fine. Okay, now let's take a look at bonds. The 20-year TLT, the 20-year Treasuries. This was selling off because interest rates were rising. Okay, so the bond prices go down when interest rates rise, and vice versa. When interest rates go down, bond prices rise. Okay, it's an inverse relationship there. So here you can just see that we're off our highs or for interest rates because the bonds went up. Okay, this little rally in bonds shows that the longer end of the curve, longer end of the curve, meaning the between shorter and longer, longer end of the curve, these are off of their highs, interest rate wise. Okay, and so prices went up. Now we might have seen the end of that and we're headed back down. I don't know, we're having a down day. And of course, lastly here on SHY, which is 1 to 3 years, very near term, it's really the same pattern. It's just a much more subtle sell-off. The last thing I wanted to look at was volatility, and that will take us into looking at talking stocks and selling premium today. All right, so let's look at volatility here on VXX as soon as it pops up. All right, and we'll go with that. So as you would expect, volatility is inflated a little bit, it's elevated a little bit, and causing option prices to be more expensive across the board. Now, every stock has a different, has its own implied volatility, and it will be somewhere between 1 and 100 as far as its rank, and we'll talk about that more in a moment. But the VIX is elevated. It's above, it's above 20. All right, trading up near 30. Closer to 25 than 30 right now, but we did touch 30 back in December, and we're looking at testing that possibly again, depending on, what people are fear and greed, really, the fear factor. All right, so let's talk about for just a moment. Let me pull up. Got a couple slides for you here. Let's talk about what to do, what to watch out for in a highly volatile and downward moving market. Now, it may you may think, oh, that's easy. But let's look at some, it really comes down to the nuances. All right. That was a question I got years ago. And I was teaching an options seminar with Tom's old business partner, George Fontanilles. We were in Las Vegas, and I got asked the question about the nuances of a certain strategy that I was teaching. And that question really stood out to me because the question was very valid. Okay. There's certain expectancies that we have from any strategy, but then there's often different nuances and little things that you can do to really make that strategy better, perform better, or have better results. Okay. And that's kind of what we're going to talk about here. So when it comes to selling premium, one thing that I want to know is the stock that I'm looking at, okay, is the stock that I'm trading held within a certain index? All right. Now, why do I want to know this? Well, I want to know that if the index moves, then I have a general idea of how this stock may be performing, and that hence my option strategy behind it. Okay. So I want to know, is it within an index? Okay. Secondly, is the stock I'm trading highly correlated to that index? Okay. Because most indexes, many indexes are weighted. Okay. So certain stocks have more influence on the performance of that index. Okay. You can imagine that the Dow Jones Industrials, which consists of 30 industrial stocks, that pretty much it's pretty easy to see which stocks account for a big move in the Dow Jones Industrials, because you're only looking at 30. It's pretty easy to figure out, hey, which one's going to have the biggest impact on that index. Then when you go out to the S&P 500, gets a little watered down. There's a few names. Nasdaq, same thing. Now you're looking at a lot of stocks, but we all know that you're going to have the big tech players are going to dominate the Nasdaq, and then Russell is its own animal. Okay. Now, another question is, does the underlying stock have liquid options so that we can easily trade in and out if we need to adjust or exit our position? Okay. Now, when we sell option premium, this does tend to take away from the concern over this a little bit, because we usually let these options expire. Okay, we take it into expiration, we let these options expire. There's no cost then for getting out of our trade, and these options expire worthless. Okay, and we keep that credit. All right, that's what we're looking for. Sell high, buy lower, or have that stock, have those options expire worthless. And when they're worthless, we get to keep that credit. Okay, and lastly, what's the current implied volatility ranking for the options that I'm trading? Okay, so I don't want to be necessarily selling premium on something that is having historically low implied volatility. Okay, because that puts me then at a slight disadvantage. Remember, Las Vegas wasn't built on winners. Okay, they are built on, of course, having an edge over all the gamblers. Okay, that little edge turns into billions of dollars. Okay, because there's so much money coming through. Doesn't seem like very much on the top. Okay, because you're talking a few pennies or dollars, but man, when you have a big volume, okay, then it makes a big difference. And that's kind of where implied volatility ranking comes into play. I want to put certain things on I want to get the edge. I want certain advantages. And as somebody that is trading on screen, okay, we're not floor traders, okay, we're trading on screen. There's a few things that we want to do to give us an edge in that space. All right. So it's really these kind of questions that you want to take a little extra time and ask yourself, when you're going out and selling premium. Okay, so within Rocket Wealth, okay, that's what I'm doing when we're looking at publishing a case study in Rocket Wealth. I'm taking all these into consideration. The one that's missing here that I failed to add was technicals. I want to see how the stock is trading. If it's dropping like a rock, none of this other stuff matters. Okay, if this stock is just dropping violently and it's moving down fast, I don't want to be selling puts. Okay, could you sell calls? Yes, you could sell calls. However, so there's certain disadvantages to selling calls, but you can do it. Okay, the answer is usually in the options world when somebody asks, "Can I do this?" The answer is always yes. Okay, but you have to know the expectations. You have to know what happens if you do that. What can you expect? What kind of return can you expect? What kind of volatility can you expect? And a lot of people don't take that into consideration. All right, so let's talk about that a little bit. So we harp on this quite a bit here. We come in and we go to our rankings lists, okay, and it's really easy to find out where stocks are trading relative to their historical past when it comes to option implied volatility. All right, so one thing to note, okay, and many of you may know this and some of you may not, and that's okay. Notice here the first ETF listed here is the Spider, okay, and this is the expensive list, okay. We're looking at our expensive 1 year IV implied volatility, and you'll see a number here. The high IV is 28.94. Okay, current IV is at 28.94. So this IV, okay, looking back, is at the 100th percentile. Okay, it's at the top of its range. It could go higher. Okay, that IV could go higher. Now you look at the next stock down, and it's Bank of America, and it's got an IV of 43.74. The next stock down, 45.51. And it's important to know that the IV of Wells Fargo has nothing to do with the IV of Bank of America, even though they're in the same industry. Okay, Bank of America, its 1 year IV implied volatility relationship has no bearing on the Spider Index Trust. Okay, they're their own levels of implied volatility is kind of self-contained. It's its own little protected environment. Okay, so it's just relative to the stock. All right. Now, what's interesting here is that we're seeing high implied volatility on really big names. Okay, we're seeing it on GLD, or we're seeing on Schlumberger, big names, Morgan Stanley, Coca-Cola, Alcoa, U.S. Bank Corp. We're seeing big names that are on the high end of 1 year implied volatility. Okay, now I haven't looked, but let's look at the other end of the spectrum. Okay, let's look at cheap 1 year. Notice here, Activision Blizzard, ATVI. Its high implied volatility was 45.98. Its low was 11.92, and it's currently at 12.92%. Okay, so it's in its lower thirds of its 1 year implied volatility. Okay, so what I mean by that is the scale is 0 to 100. Okay, we knew that Spider was trading at 1.0 or 100, meaning it's at its highest. Okay, here I know that this is trading in, if I divide that 0 to 100 into thirds, okay, 33% each, then I know that this is in the lower 1/3 of the 1-year IV for this stock only, okay? So I probably don't want to be trading implied volatility, even though I still could, okay? The trade-off here on selling premium on something like Activision right now with 1-year low implied volatility is that I have to come closer to the money, meaning I have to take on a higher degree of risk because I'm so close to where the stock is trading. That's the disadvantage. I can still sell premium, all right, but hey, it's a big risk, all right. So if I go back to expensive here, okay. Now I've showed this before, but I know that we usually have, we have different folks on here on a regular basis, so I'm going to repeat it. And there are some tools out there that do it. I'm using Tom's tools, all right. I've used Tom's tools since they were created back in, I don't know when it was, late 90s, early aughts, late 90s, I think it was, the basic version of it. So it's been out for a long time. All right. One thing I love about it is just how clean it is. It doesn't have all these cool neon flashing lights and handsome charting. It's just my basic fundamental information that is worth its weight in gold to me. Okay. All right. So here's what I'm going to do. I'm going to take, all right, 250 of these stocks that are expensive right now. All right. And I'm going to save them to a list. And right now, I'm just going to use a default list called My Stock List. And what I put in My Stock List, some people put names of regular stocks they trade. That's fine. I usually put stocks that I'm currently working with. Okay, the latest thing that I'm looking at. So oftentimes I don't remember what I put in there. It's kind of an age thing, I guess. But I do know that it's the latest thing or latest project that I was working on. So I'm going to put those, dump those into my list, and just like that, boom. It happens fast. All right. And first of all, let me make sure. Oh, this list is going to be different because we need to update it here. Let me update it again. Okay. So we have Spider, Bank of America. Well, okay. So it's pretty. It's near the same, but let me just replace that list with the current 250. I just noticed. Oh, okay. I see what's happening here. It's end of day only. So it's taking yesterday's ranking. That's why. Okay. Not a problem. All right. So I have this list. Now, I could go and possibly sell premium on anything in this list, but I want to know something else. Remember those things I talked about is knowing what is the correlation. Well, by golly, I know that a lot of these instruments here are probably going to be highly correlated to the broader market, except for, now I happen to know this just from experience, but things like gold, okay, maybe emerging markets, possibly, but definitely TBT, which is or that might be high. We'll see. Let's, instead of speculating, let's look at the actual results. Okay, so I have that list. Now, the next thing I want to do is I want to come up here, and Tom's Tools has this neat little thing called correlation analyzer. Okay, so we can come down here to correlations, and I can take my list. All right, and I can compare it to really anything I want. One thing that I can compare it to is all the broader indices. Okay, well, I don't want to do that because right now, with the broader market selling off, I'm looking for stuff that's not really this may be non-correlated. Okay, maybe it's doing its own thing or it's going higher. Okay, so what I'm going to do is set this up to where I search a specific symbol. Okay, and this is going to be spider, and then I'm going to look up here, and we're going to talk about the differences between these two things here: inversely correlated and extremely non-correlated here. Okay, so first, inversely correlated, I don't look for that very often because that's pretty simple. If the market goes up, it's going to give me products that go down, inversely correlated. If the market goes down, then those products go up, inversely correlated. Now, extremely non-correlated pretty much means these things are going to do what they do. They're their own thing, meaning they're not going to be highly correlated. So I'm going to take my stock list. Oops, nope. I'm going to do it to spider. Okay, and make sure I'm on my stock list. Yep. And so I'm going to analyze this. Now I'm excited here because I don't know what I'm going to get. I haven't done this yet. All right. All right. So we have here a list of stocks. Now, kind of wish this would publish this vertically, but it publishes it horizontally. Now you're seeing some names here. Okay, and let's look for possibly names that we recognize. Okay, for example, is this Kroger? Okay, KR. Okay, so what's going to happen here? All right, let's look for a name that we recognize. Okay, C. All right, and love the one-letter symbols here. Okay, seeing those. Okay, so what you're going to get is you're going to see stocks that are uncorrelated to the broader market. Now, here's the thing. These stocks could be going down right now. Okay? These stocks could be going down right now. So I could go through these one by one. Here's JetBlue. I could see if one at a time. Okay, this looks somewhat correlated. Actually, it doesn't. Okay, you can see here kind of what I'm talking about. This is why. Okay, so here the market's going up. Okay, this stock was going down. Okay, there's your, okay, but sometimes they move together. Okay, so here, right now, they were moving together. All right, so, but majority of the time, they're not going to move the same direction. That stock has its own little personality. So the bottom line is, I can take this list and let's say I'm going to take 100 of them, okay, and I'm going to dump these in here. These are going to be the 100 least correlated stocks to the S&P 500. Okay. Now, what I want to do, so where are we? Okay. I know that I searched an expensive IV list. Okay. Now I know all these stocks have expensive IV options. Now I've looked for those that are not correlated, okay, or not highly correlated to the broader market. Now, if I'm selling puts, okay, what I want to know is actually how these things are moving. All right, so I'm going to come in here and seek out a little. It's called, well, some people might call it cheating, but I'm going to call it smart. Okay, I'm going to come in here to this little wizard that says moving averages. Okay, and I'm going to set my short term to 10 days. I'm going to set my long term to just 30 days, and I'll tell you the reason why I do this in a little bit. But I'm going to come over here to my wizards, and I want to do most days. Okay, since bullish moving average crossover. Okay, now, so what this is going to tell me, instead of me searching one by one looking for stocks that might meet my criteria, this is going to allow me to then look for these, like, look, out of those 250 stocks that I narrowed down to 100, now it's down to 67. Okay, And so take a look at this here. Okay, here's Chevron. Now this would make sense. It's in the energy space, right? Boy, look at Chevron, just exploded to the upside in the past few days. Okay, yeah, that one makes me a little nervous, right? Okay, here's Rio Tinto, same sector. Here's Altria. Okay, when it's funny, it's one of the sectors, one of the safe havens back when back in the old days when markets went down, were people used to flood. So people would go to the SIN stocks, SIN stocks. Those included things that were in alcohol, gambling, other sectors that some more religious folks might call sins, right? So sin stocks. So Altria, okay, we all know this is the old Philip Morris, right? Okay, smoking. The old adage was when people when started losing money because the stock market was going down, they started to drink more and they started to smoke more. Okay, so people would flood into Anheuser-Busch or Altria or whatever, right? And so there's always a bullish market somewhere. Okay, now you have Western Union here. Okay, and okay, so it's actually pulling back a little bit, but you can see here that the pattern doesn't look like the Spider Index Trust at all. Okay, now okay, so and here's Philip Morris. So it spun off, so they both still trade, but all right, and here's Mosaic. Okay, and you can see, man, boom. All right, so now what do we do here? Well, we come in and we take this list. Oh, and let me replace it. So replace. So now I'm down to 67. Okay, now I'm down to 67. So I went from 250 to 100 to 67. Okay, now I have a searcher that we use. Okay, and it's called sell puts. There's a little bit more math behind it. All right, but what I'd like to do here is I'm going to search my my list, okay, and there it is. Okay, all right. So that list I'm going to search, and there's some criteria here. Most of the time, sometimes I adjust this one where I'm trading 45 to 90 days, and, so it's going to look for a range. All right, and there's all sorts of other filters, and I only want maybe 2 trades per stock instead of the default of 5. All right, so I'll go ahead and search this. All right, and so what it's going to do is kind of guide me. All right, it's kind of like cheating, right? All right, so and how this how this gives me results is a couple of different ways, but how it sorts them is a mathematical formula of taking the probability of profit. Okay, no, so think about that. What it's doing is selecting a trade, meaning an option to sell, that has a certain probability of profit. Now you might think, oh well, I'm just going to sell anything with an 99% chance of winning. Well, there's been some research that's been recently done talking about the risk of doing that. Yes, you want to sell. We love selling out of the money options, but what we might want to do is come a little closer because we get a little bit more premium. And with a little bit more premium comes a little less risk. And with a little less risk, I mean, you can go way out, but we want to be within a certain range. Okay, so this uses this calculation, probability of profit times the credit that we receive divided by the close. All right, so that math spits it out, and I get these ratios here. All right, so then I kind of look at premium here, and then I see on it, let's take a look at AA here. All right, so we see this stock is okay, it's going up, but it's not going up in a violent fashion like what was that Chevron was. Okay, and we can come in here and we can see if this is an ideal candidate. All right, so we know that okay, so this expires in May. It's a 60 strike put. The stock is trading at 82. Okay, so what this is going to do is tell me, hey, this has got a certain probability of success. This is based upon this credit divided by the close, and this is a good area to be. Okay, all right, so let's see how some of these things have been performing, some of our open positions. Because what happens when in real life when things start moving around? Okay, and you know, I'm zeroed in on this credit, but what happens if instead of green here I have red here? All right, well, actually, I think it's Nvidia. This is one of the cases here. Currently, now this is an open position for Rocket Wealth. All right, this is a current position from Rocket Wealth. Um, um, we got a profit, well, which is a loss right now of $55. And so you look at that and you're like, okay, well, that's not much. Okay, so I'm good there. But what I always want to look at is where is this thing technically? All right, and you can see here that we rallied into earnings, but after earnings we sold off. Notice we carried this trade through earnings, okay, partly because I wasn't really worried about it. But we have tested now twice, kind of like the Russell, okay, these lows here, and ironically, it's our break even at expiration. Now, this trade expires in a little over 2 weeks, okay, and we're down in the position. So here's what's going to happen. I have a lawyer friend of mine. She does a lot of federal cases, and she has a great line. And if you know this woman, when she says this, it scares the crap out of me. But it's funny. She says, let me tell you what's about to happen. Ugh. And the way she says it, it's hilarious. Okay, anyway, let me tell you what's about to happen here. Okay. What's about to happen is we're about to start making money if the stock stays above our break even, okay, and either stays where it is or moves higher. So think about that for a second, okay? The stock could stay where it is. What can a stock do? A stock can go up, down, or sideways. Okay? Up, down, or sideways. We are looking at a stock going, we need it to go sideways or up. 2 out of 3. Well, that means 66%, right? Actually, closer to 67 maybe. All right. So I've already got a 66% chance of success right now just because it can win 2 or 3 directions. In fact, it could even drop a little bit. Okay, it's currently trading at 240 and change. I need it to stay above 215. Actually, well, 215 is my break even. I really need to stay above 220, which is my short. Okay, it's at 240.45, so it's $20 away. So if this stock drops $10, I'm okay. Okay, I'd rather it stay here or move up. Okay, and that's when theta will kick in. Okay, that's when theta will kick in, and so right now, if the stock stayed right where it is, I'm making $30 a day. Okay, $30 a day, and that number is only going to get bigger the closer we get to expiration. Okay, closer we get to expiration. Now, on that trade I just showed, that reminds me, I did not look at implied volatility, but I'll go back over there in just a second. All right. So for Nvidia, it was showing as a loss when I ran the numbers. I'm like, okay, where are we? My first reaction is not, oh no, panic. My first question is, where are we technically? Okay, and technically, hey, we're bouncing off lows. Okay, this stock did drop since we opened this position back on January 5th. All right, this stock started heading down. It wasn't a bullish profile until it broke this previous low over here at 275, and then it kind of became short-term bearish. But let's look at a couple of others here. All right, Ulta, which is another open position, it's doing nicely. Okay, now look at this. This is a good example of a stock that's non-correlated. All right, so this is what I'm talking about. You can see here that this stock is just pretty much trading sideways. It's trading sideways in a big range. I mean, this is a $300 stock, closer to 400. All right, and you can see here that we bounced off of 350, okay, as support, tested it once again. We're well above our break even here, okay. Now earnings are in 8 days, so you have a decision to make. All right, right now of the profit that we, or the credit that we took in, okay, we have recovered. We're at 50% return on of our credit, okay, meaning 232, 460. Okay, we've gotten half of our credit. If you don't like holding things through earnings, well, you could take this off, okay, before earnings, and you would end up having whatever profit is available at that time. Notice here we sold this for 460. It's currently trading between 215 by 240. All right, so somewhere in that middle there, all right, is where you would go. Now, let's look at one more here. This is another open position for Rocket Wealth. This is on Callon Petroleum. Notice what the stock is doing. Totally uncorrelated to the S&P 500. Totally uncorrelated to the Nasdaq. Oh, it's not in the Nasdaq. Okay. I want to know, is the stock, is the stock in the index? If it is, which index is it in? Is it widely held? Do a lot of people have it? Do a lot of institutions have it? Okay. We have, all right. So, in fact, on Callon, well, that was something that we looked at, when I was looking at Callon. Okay. And here we have 43 days left. Now, here's the thing about Callon. Okay. And this is why I pulled this one up. We have a decision to make, and it's something that we will probably do. I like doing it, and I'm talking to Tom about it. Okay, when we sell something, in this case, it was for a $3 credit, which is $300. All right, 80% of that 300 is going to be about 280, I believe. All right, so 80%. Oh, 240. Sorry, 240. Okay, we have a profit of 215. Right now, when we hit a profit of 240 or more, consider taking this trade off. And here's the reason why. Is because if this thing hits, say, a profit of $245 in the next week, okay, and we still have over 35 days to expiration, there's no reason to wait another 30 days to get that last 20% of profit. You've got 80% of your return. Take it off. Reset your buying power. Okay, buying power is not something we talk about a lot, but it is critical to, well, your ability to place trades. Okay, you got to have the buying power available. Okay, so that's why I wanted to show you Callon, because we're getting close to that 80%, and you really might want to start thinking about taking this off. Notice we did take this one through earnings again, again, another stock. And the reason is simple. I look at past earnings. I see how the stock reacts around those past earnings. I can expect, maybe, unless something materially big has changed, nothing's going to happen. And in this case, actually, we've got a little rally, a little pop here today, and all those petroleum stocks are jumping up, which is good. So as a final little going away present for those of you that are, hey, they like, you like these tools. Let me just drop a link, and I've mentioned this before. I'm going to go back, and if anybody has gone through here and has looked at this, I'm going to try to track down and do we'll do a little testing or a little call on this software for you for free. I mean, just, hey, you're the call won't cost you anything, but obviously the software does. So if you're interested, just take a look at it, and then we can, for those of you that do look at it, then we can talk and show you, how to run some of this stuff, and we'll be good to go. So really, that's it for today. Let me just update here. Let's just take one last look at. Again, this is delayed data a little bit, but let's just kind of see where we are. Hey, we're trading new highs on the day here, okay, on Spider, heading back up to short-term moving average. So very good day on the broader market here for us, and good day for selling premium. Expensive IV market rallying. You couldn't ask for a better setup. But I'm careful saying that because obviously things can change. Don't fight the Fed. Be aware of geopolitical events. It's very, very important that we look at that. Okay, well, that's it. Hey, I appreciate all of you joining me. Thank you very much for hanging out. And I'll see you next week. And we'll go over this again. We'll go over more stuff as it relates to selling premium and the world of Rocket Wealth. All right, everybody have a great day. Take care.